Before you cash out your 401k to open a cannabis dispensary thinking you will smoke top-shelf inventory for free while pulling a 50% gross margin in cold hard cash, look at the actual balance sheets. 73% of all U.S. dispensaries are currently bleeding to death, buried under federal tax penalties and armed security retainers. Walk into a high-end dispensary in Denver or Chicago, and your first impression is sheer luxury. It looks less like a head shop and more like an Apple store designed by a high-end architect. Warm, recessed LED lighting, precision glass jars, and a line of eager consumers wrapping around the block with stacks of $100 bills in hand. You do the quick math in your head. Buy low, sell high, take cash, and serve an endless line of buyers. But that crowded front store does not translate to net profit in your safe. On paper, it looks like an automated cash printing machine. In reality, it is a meticulously engineered liquidity trap. Here's the financial autopsy. If you want to master the ruthless economics that Wall Street will not tell you, hit subscribe now to unlock our full financial forensics archive. To understand how this trap springs shut, meet Tyler. Tyler is a 30-year-old suburban consumer living just outside Denver. He spends over $300 a month at his local dispensary on premium vape cartridges and craft flower. Like millions of Americans who participate in the legal market, Tyler eventually falls into the ultimate consumer illusion. He calculates his own annual spend, multiplies it by the packed parking lot outside his favorite store, and arrives at a fatal conclusion. Why should he keep transferring his hard-earned paycheck to someone else when he could open his own retail storefront, collect physical cash from his neighbors, and consume top-shelf inventory at a $0 wholesale cost? It sounds remarkably simple. Find a commercial space, submit an application, build out a clean retail floor, buy wholesale inventory, and flip the open sign. With that naive confidence, Tyler begins assembling his initial capital stack. He empties his personal savings, takes out a home equity line of credit against his suburban house, and borrows money from family and friends, raising a total of $850,000. On paper, nearly $1 million in startup liquidity feels invincible. In reality, it's a drop in the ocean compared to the mandatory regulatory matrix waiting for him. Tyler's first exposure to capital destruction is the sticker price trap. Under federal law, a cannabis dispensary is not a standard retail shop selling packaged consumer goods. Under federal law, it remains a commercial facility trafficking a Schedule I controlled substance, conditionally tolerated at the state level. That legal friction inflates initial upfront capital expenditure to astronomical levels. Before Tyler can even lay a brick, his non-refundable state application fees consume $15,000, vanishing instantly into state bureaucracy with zero guarantee of approval. Once approved, state regulations mandate that his physical space be constructed like a high-security commercial vault. Commercial-grade reinforced safes, steel-lined storage rooms engineered to resist forced entry, and a continuous 24/7 high-definition surveillance matrix covering every inch of the floor run him $350,000. On top of that, state regulators require 90 days of uncompressed video footage stored on secure local servers for surprise audits. He then spends another $150,000 in liquid cash just to purchase his opening wholesale inventory. Yet, capital expenditure is not the lethal wall. The real killer is regulatory delay. Explanatory, municipal zoning rules dictate that dispensaries must sit 500 to 1,000 feet from schools, churches, parks, and residential zones. This shrinks compliant commercial properties to a handful of addresses on a city map. Commercial landlords exploit this scarcity by charging a cannabis premium, doubling or tripling market lease rates to $18,000 a month for a vacant shell. Tyler's application processing takes 18 long months. For a year and a half, his revenue remains precisely zero while he bleeds $18,000 a month in rent on a dark building just to hold the location compliant. Grimly, by the time his state license is signed, Tyler has burned through $324,000 in pure holding costs before selling a single gram of flower. Tyler finally cut the ribbon on opening day, believing the hard part was behind him. He was violently wrong. On paper, Tyler's first year of operations looks like an absolute triumph. His grand opening draws massive crowds, and within 12 months, the registers ring out $1 million in gross retail revenue. To an outside observer, Tyler has made it. He's running a million-dollar business. But inside his accounting office, the reality is a brutal hemorrhage of cash. Revenue is a vanity metric, gross profit is merely a breathing valve, and after-tax cash flow is the only thing that dictates survival. Tyler is about to be systematically dismantled by 3 operational blades. The first blade cuts from within. It's the insidious trap of internal shrinkage, born directly from Tyler's original motivation to open the store. Because Tyler and his newly hired bud tenders are heavy daily consumers themselves, the boundary between commercial inventory and personal use instantly blurs. Under the casual guise of quality control testing and product familiarity, Tyler and his staff routinely pull premium flower, top-shelf concentrates, and high-potency edibles directly off the backroom shelves. What feels like a harmless perk of ownership adds up with terrifying speed. Every month, $3,500 worth of wholesale inventory vanishes without a single dollar of offsetting revenue entering the register. Over a full year, that is $42,000 in pure, unrecoverable cash bleeding directly out of the business. Worse still, state regulatory compliance software like Metrc tracks every single gram from seed to sale. When physical inventory audits fail to match digital logs, Tyler faces regulatory fines and the constant threat of license suspension, turning a habit of free consumption into a legal nightmare. The second blade is the extortionate cost of operating an entirely cash-only business. Because cannabis remains federally illegal, major financial institutions refuse to provide standard merchant processing or business checking accounts. Tyler cannot accept credit cards or standard electronic bank transfers. He is forced to operate a cash vault. To manage millions of dollars in physical bills, Tyler must build an expensive workaround infrastructure. He pays $8,000 a month for armed security guards to patrol the retail floor and secure the vault 24 hours a day. He pays another $3,500 a month for armored transport services to haul heavy duffel bags of cash to secure facilities. On top of that, a small local credit union agrees to hold his business deposits, but charges a regulatory maintenance fee of $2,000 every single month just to take the risk. Before paying a single employee or purchasing a single piece of inventory, Tyler is burning nearly $160,000 a year simply for the privilege of holding physical currency. Yet internal theft and cash handling expenses are minor inconveniences compared to the third blade, the ultimate death sentence known as IRS Section 280E. This relic of the 1980s war on drugs was written to prevent illegal drug cartels from deducting their operational expenses on federal tax returns. But because legal dispensaries traffic a Schedule I controlled substance under federal law, Section 280E applies directly to Tyler. Let us look at the real math on Tyler's balance sheet. Out of his $1 million in gross revenue, Tyler pays $500,000 to wholesale cultivators for his product. That leaves him with a gross profit of $500,000. To run his store, Tyler spends $400,000 in ordinary operating expenses: rent, bud tender payroll, armed security, armored cars, utilities, and Metrc compliance software. Subtracting $400,000 of operating expenses from his $500,000 gross profit leaves Tyler with a real pre-tax net profit of $100,000. In any normal retail business, the IRS would tax that actual $100,000 net profit at the standard corporate rate of 21%, resulting in $21,000 in taxes and leaving Tyler with $79,000 in clean profit. Then the IRS tax audit arrives. Under Section 280E, federal law explicitly forbids dispensaries from deducting ordinary business operating expenses. The IRS completely ignores Tyler's $400,000 spent on rent, payroll, and security. They assess his tax liability based strictly on his $500,000 gross profit. At a 21% federal tax rate applied directly to $500,000, Tyler's federal tax bill is not $21,000. His tax bill is $100,005. Look at those numbers carefully. Tyler's business generated $100,000 in real net profit before taxes, but his tax bill to the federal government is $100,005. After working 80 hours a week, managing security risks, navigating bureaucratic delays, and serving thousands of customers, Tyler is negative $5,000 in cold cash. He worked an entire year, generated $1 million in sales, and paid $5,000 out of his own pocket for the privilege of losing his life savings. If an independent operator like Tyler gets wiped out by 280E, how do the multi-state corporate giants survive this landscape? They don't. They just hide the bleeding better. It's easy to look at a small-scale entrepreneur like Tyler and dismiss his bankruptcy as the amateur failure of an inexperienced operator who consumed his own supply. But if you think this financial hemorrhage is limited to unsophisticated single-store owners, you're missing the entire macroeconomic story. The exact same structural trap that destroyed Tyler's balance sheet is currently crushing multi-billion-dollar corporate enterprises backed by institutional capital and an army of Wall Street attorneys. To see this cold reality played out on a massive scale, look directly at the audited SEC filings of one of the largest and most successful multi-state operators in American history, Green Thumb Industries, Inc., trading on public markets under the ticker GTBII. Green Thumb represents the gold standard of public cannabis enterprises, operating fully integrated supply chains with dozens of retail storefronts and state-of-the-art industrial cultivation facilities across the country. Yet, when you perform a financial autopsy on Green Thumb's official SEC Form 10-K filings, comparing their peak golden year of 2021 against the realities of 2023, you find definitive proof of just how unforgiving this market is. In 2021, during the height of the post-pandemic market surge, Green Thumb posted $893.6 million in gross revenue. Their cost of goods sold sat at $401.3 million, leaving them with a massive gross profit of $492.3 million and a stellar 55.1% gross margin. After accounting for operational costs and their massive tax obligations under Section 280E, Green Thumb generated $75.4 million in clean net profit, achieving an 8.4% net margin. In an industry defined by losses, this was considered a masterclass in execution. Now look at what happened just 2 years later in 2023. Green Thumb's top-line gross revenue crossed a historic $1 billion milestone, hitting $1.054 billion. That represents an increase of more than $160 million in top-line sales over 2 years. A retail investor skimming financial headlines would assume the company was thriving, expanding its empire, and minting cash. Look further down the audited income statement to see the underlying structural crisis. Because of massive agricultural oversupply in cultivation states like California and Oregon, combined with relentless price undercutting from the illicit market, wholesale prices for raw flower collapsed. At the same time, inflation pushed up packaging, energy, and labor costs. Green Thumb's cost of goods sold surged 35.8% to $545 million. Their gross margin compressed from 55.1% down to 48.3%. Operational expenses climbed to $317 million, driven by expanding physical locations and compliance overhead. And then came the brutal punchline at the bottom of the page. Despite generating an extra $160 million in gross revenue to break the $1 billion barrier, Green Thumb's net profit plummeted by 51.8%, collapsing from $75.4 million down to just $36.3 million. Their net profit margin was sliced in half, dissolving from 8.4% down to a razor-thin 3.4%. Read those audited numbers again. Green Thumb grew its top-line business by over $160 million, yet its actual take-home profit was cut in half. They were caught in the exact same economic vice as Tyler. Raw cannabis flower, the core product that built the industry's reputation and still drives nearly half of all retail transaction volume, has officially transformed into a loss leader. Massive agricultural overproduction has commoditized raw plant material, squeezing gross margins on flower down to levels that barely cover real estate leases. If a multi-billion-dollar corporate enterprise with vast economies of scale and vertical integration sees its net profit margin compressed to 3.4%, a single-location retail operator has virtually zero statistical probability of long-term survival. So where did all the money go? If the single-store operator goes broke and the billion-dollar multi-state corporation sees its profit margins sliced in half, who is actually extracting the wealth generated by this industry? To find the real winners of the American green rush, you have to look outside the retail storefront and look up at Wall Street private equity firms and specialized real estate investment trusts, known as REITs, such as Innovative Industrial Properties, trading under IIPR. These institutional entities figured out the ultimate financial arbitrage. They recognized early on that federally illegal businesses cannot access traditional commercial bank loans or mortgages to purchase commercial land or build out specialized retail facilities. Instead of taking on the operational hazards, security costs, or the deadly tax penalties of Section 280E, Wall Street created a financial weapon called the Sale-Leaseback Agreement, wrapped in a triple net or NNN contract. Here is how the arbitrage works. An institutional REIT steps in and purchases the physical commercial real estate or cultivation facility from a cash-strapped cannabis company. The REIT then immediately leases it back to the operator under a long-term triple net lease. Under a triple net lease, the tenant operator agrees to pay a base rent that is artificially inflated far above standard commercial market rates, while also assuming 100% of the financial burden for property taxes, building insurance, structural repairs, and security upgrades. The REIT assumes zero operational risk. They don't sell flower, they don't manage bud tenders, they don't handle cash vaults, and they're completely immune to Section 280E because their income is purely derived from commercial real estate rent, not the sale of a controlled substance. Cynically, if the dispensary operator like Tyler goes bankrupt, the REIT simply reclaims the fully upgraded high-security bank vault facility and releases it to the next optimistic entrepreneur standing in line. While independent operators bleed cash to pay armed guards and the IRS, Wall Street REITs collect predictable, tax-sheltered rental yields of 12 to 15%, distributing safe dividend checks to institutional investors. It's the classic Wall Street playbook rewritten for the modern era. In a gold rush, the gold diggers go broke competing for shovels, while the institutional landlord who owns the dirt underneath the mountain takes a guaranteed cut off every single bucket of earth moved. So, how does a surviving operator rewrite the rules of this broken system before the IRS marshals lock the doors? So, how does a dispensary operator survive when the entire tax code and real estate structure are engineered to drain their cash reserves? The operators who make it through this regulatory meat grinder do so by making a fundamental mental shift. They stop behaving like passionate product enthusiasts or daily consumers, and they start operating strictly as ruthless defensive engineers of a profit and loss statement. Survival requires a complete structural redemption across three core operational pillars: product mix, real estate liabilities, and inventory discipline. First, successful operators execute a radical derivatives pivot. They recognize that raw cannabis flower, the product that built the industry, can no longer carry the business. Raw flower gross margins have collapsed from 60% down to 30% due to agricultural oversupply and illicit price pressure. Relying on raw flower to pay $18,000 a month in commercial rent is a guaranteed path to liquidation. Instead, smart operators treat raw flower strictly as a loss leader, a cheap bait product designed solely to drive foot traffic through the front door. The real profit engine belongs entirely to processed derivatives, THC edibles, vape cartridges, concentrates, and private label house brands. While raw flower carries a razor-thin margin, manufactured derivatives command gross margins of 65 to 75%. The raw input cost of a gummy or liquid distillate cartridge is extraordinarily low, yet because these items are packaged, branded, and positioned as clean, discreet lifestyle goods, operators can apply a 4 to 5 times markup over wholesale costs. Encouragingly, by aggressively retraining bud tenders to convert flower buyers into high-margin derivative and house brand purchasers, a dispensary can double its gross margin dollars without increasing its foot traffic by a single customer. Second, surviving operators engage in aggressive lease re-engineering to break their fixed cost rigidity. Signing a long-term, fixed-rate commercial lease charging an $18,000 monthly cannabis premium creates a rigid cost structure that crushes cash flow during seasonal sales lulls. Instructively, to hedge against this, sophisticated tenants negotiate lease terms to incorporate a percentage rent over breakpoint model. Under a percentage rent agreement, the operator pays a lower, sustainable base rent, say $8,000 a month, to cover the landlord's basic carrying costs. In exchange, the landlord receives an agreed-upon percentage of gross retail sales once the store crosses a specific revenue breakpoint. This aligns the landlord's financial incentives directly with store performance. During slow winter months or regulatory delays, the store's fixed rent burden drops, preserving critical liquid cash reserves instead of forcing the business into default. Third, operators enforce absolute inventory containment by eliminating internal shrinkage. The culture of treating wholesale inventory as a personal perk or offering untracked quality control samples to staff must be completely erased. Professionalized operators implement real-time inventory reconciliations synced continuously with state-monitored Metrc seed-to-sale tracking databases. Every single gram of product entering the vault is weighed, logged, and tied to a verified digital point-of-sale transaction. Any physical discrepancy between the vault and the digital ledger triggers an immediate internal audit. By treating cannabis inventory with the same strict accounting controls as physical cash in a bank vault, the store plugs the thousands of dollars in monthly cash leakage that silently destroys independent dispensaries. To survive in a market squeezed by federal law and tax penalties, you cannot run a business for product appreciation. You must run an uncompromising financial system. Strip away the shiny glass counters and the smell of top-shelf flour, and you're left with a single, undeniable truth about modern business. The cannabis industry was never designed for enthusiasts seeking $0 product perks or starry-eyed entrepreneurs mesmerized by top-line revenue numbers. It is a ruthless game of institutional survival governed by liquidity management, draconian tax codes, and unforgiving real estate liabilities. Building lasting wealth is not about chasing hyped retail trends or high-grossing storefronts. True financial defense begins with an unwavering skepticism of easy cash printing machines and the discipline to thoroughly analyze tax codes and regulatory friction before deploying a single dollar of your hard-earned capital. If you can't survive the hidden regulatory matrix buried inside the balance sheet, the business will liquidate you long before you ever harvest a profit. Which billion-dollar asset class or hidden financial trap should we dissect next? Drop your thoughts in the comments below, and don't forget to share this video with someone who still believes owning a retail storefront is easy money.